Well, right now we have Abu-Bakr Suleiman back online, the Chief Financial Officer for Sterling Bank, to give us the facts behind the figures here on Sterling Bank's first quarter results. Well, thank you very much for joining us, Abu-Bakr. Now, Sterling Bank recorded an increase of 22% on gross earnings quarter on quarter. Is this increase still as a result of the merger with ETB, or what's driving this growth?
As we indicated last year, the merger was supposed to provide a platform for us to grow. We have concluded the merger and we are ready for growth now. Our numbers last year indicated a deposit growth of 18%. We think that this year is going to be significantly superior to that because we no longer have to deal with issues arising from merger. If you ask me, I think the platform is ready for the next phase, and the merger is only the foundation for that growth.
There was a significant increase, a huge jump of about 110% on investment and other operating income. Well, that's about 3 billion naira increase. Now, what is the explanation for this?
There are three major events that have happened in Sterling Bank. The first one is that we have significantly increased the liquidity in our balance sheet. And so in the first quarter alone, we saw a 13% growth in deposit, which if you annualize will give us close to 50% growth by the end of the year. The increase in growth was also marked by a fairly decent growth in risk asset. We saw an 8% growth in our risk asset. And so the additional liquidity has allowed us to continue to reduce our cost of fund, which is down 40 basis points from December last year, and also to become more active in our treasury activities.
Do you think this can be sustained? Do you see it being sustained over the year?
We are confident that this will be sustained, and our response to the growth that we have demonstrated is to strengthen our balance sheet further by raising capital. And so as we have announced, we intend to do a right issue to raise capital by the second quarter of the year, going into the third quarter.
And how would you rate the company's security exposure at the moment?
Essentially, we have a duration on our security that is less than 2 years. So the bulk of our exposure to securities, which is government securities, is actually very short tenured. Significant volume in treasury bill growth in the last quarter, and where we have fixed income, it is also the bulk of it is less than 2 years to maturity. So we have a balance sheet that is fairly matched to our funding cost and funding profile.
All right, now we see the profit after tax grew by over 100%. I mean, quarter on quarter, like we discussed, mainly driven by the jump in investment income in comparison to your 2012 full-year results. That was just about 4% increase. Now, let's look at how does the bank plan to sustain these numbers?
The growth that you've seen in our numbers are as a result of sustained growth in the balance sheet. So, for example, the balance sheet of Sterling Bank in January was superior in every respect to the balance sheet in December. Even in terms of size, we had a January number that was higher than the December number, and February has also been higher. So month on month, we are growing the business. We are growing the right side of the business. The retail funding side of the business is beginning to pick up. We are also growing risk asset, but our risk asset growth has significantly been at the top end of the risk asset. Because now with a lower cost of fund, we are now able to play in corporate banking at a level that we're not able to do before. So we're growing both our retail exposure and our corporate banking exposure, and in a sense, the exposure in the middle market is lower than it used to be.
Well, your loan book, grew about 40%, while deposits grew by about 28% quarter on quarter. Now, how did the bank achieve this?
The growth in loan book, like I mentioned earlier, is driven by the fact that with a lower cost of fund, we are now able to fund the corporate banking segment of the market where we were unable to play prior to the merger. And that is likely to continue. So if you see the breakdown of our risk asset, the corporate banking exposure, the oil and gas exposure, and the exposure to manufacturing and agri have grown significantly. And we now do less in real estate and trading.
Still on the issue, what numbers in terms of loans, and deposits are expected for the end of the year? And how do you intend to achieve this?
We expect to close our loan book with about 350 billion in total exposure, net exposure, and this is going to be driven, well, first and foremost on the back of the additional capital that is required. Again, special focus for us for the year has been agriculture, education, and manufacturing. We are beginning to focus on manufacturing with some of the changes we expect to see in the larger economy going forward.
Take you on this one. What's the company's strategy going forward? Give us a breakdown of how the company intends to move forward.
Sterling Bank, with a history of merchant and investment banking, has spent the last couple of years trying to transform itself and reinvent itself. The fundamental change in our strategy is we now have on ground a solid approach for growing a retail business. This involves not just changing the technology that we deploy to serve our customers. We are also reinventing the structure of the organization such that it is now more customer-centric, and we're focusing on what the customer wants and how they desire to be served. So if you visit any of our newly transformed branches, you will find that we are bringing the retail side of the business. Our desire is to commoditize financial services such that it is available and accessible to everybody. The best way to create financial inclusion is to make banking as simple to access as any other product that the customer might want to access, and we're doing that right now. The products that we are deploying into the market, for example, are targeted specifically at people who otherwise would find it difficult to access financial services. The nature of the branch expansion that we're doing and the other alternative channels are focused on people who would find banking to be a little bit too elitist and beyond their reach. So when you see our growth in the next year, it's going to be driven significantly by inroads into retail market.